Despite escalating global volatility from the Middle East to the West Philippine Sea, real estate leaders see a strategic window for the Philippines to stand out. Jin Kim has the details.
Philippine property is gaining attention as a regional safe haven backed by interest rate cuts, foreign ownership programs, and strong demand from expats, offshore investors, and multinational firms.
In terms of environments, this is probably the most volatile environment that we've seen. We see that as an opportunity for the Philippines and obviously for the real estate market.
The proposed 99-year lease law, energy-focused REITs, and a rebound in tourism are expected to bolster capital inflows in the second half of the year. In the residential segment, demand for high-end condominiums remains strong, particularly in Makati and BGC, driven by affluent young professionals, foreign families, and returnees.
Especially as we're seeing an influx in record enrollment in some of the international schools and also some of the multinational and their families returning to the Philippines, and a lot of those going towards high-end condo living.
In the office sector, first quarter 2025 recorded a net absorption of 192,000 square meters, the highest since 2019. Taguig and Makati remain the most expensive districts, with rents above 1,200 pesos per square meter per month.
So we've essentially gone threefold in the amount of office space in Metro Manila over the last 10 years. It means that this is a strong growth year in the office market so far.
While vacancy rates in non-CBD locations remain above 20%, demand is expected to shift. The firm's recommendation:
so companies maybe who don't need the most premier location, do not need the newest, fanciest buildings, are maybe looking for just quality BPO space that is kind of no frills. We're going to see them look a little bit more at Ortigas, QC, a little bit of the Bay Area, especially around MOA, and then Alabang as well.
The REIT market is evolving beyond BPO office towers, now including energy infrastructure and retail assets, offering developers a tool to unlock capital for new projects.
So we see REITs being an efficient way to launch a business, recapitalize a business, and also to circulate that capital for reinvestment. So we see REITs being active as well, and that will make the market incredibly efficient.
In the industrial segment, data center investments are accelerating. Over 900 megawatts of capacity are in the pipeline, led by players like PLDT Vitro, Digital Edge, and Singapore's STT. In the next 6 months, inflows to property funds, data infrastructure, and mixed-use developments are expected to rise, fueled by policy tailwinds, regional positioning, and investor appetite for long-term value amid global uncertainty. Jin Kim, Billionaire News Channel.